Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Robinhood.
If you find our talks useful, please consider subscribe, like, and comment underneath. So, if I told you that one of the fastest growing retirement platforms in America right now is actually the exact same app famous for, wild meme stock gambling, you'd probably think I was joking.
Oh, absolutely. Most people would laugh at that.
Right, because when most of us hear that name, our brains just instantly flash back to a very specific, really chaotic era. We picture this highly volatile, highly speculative platform that's basically catering to people, chasing the next obscure crypto coin on their phones.
Yeah, and that is undeniably the lingering public sentiment. It's a reputation that was forged in the absolute madness of past market cycles. And honestly, it is firmly baked into how the general public and, frankly, a surprisingly large number of casual investors still perceive the company today.
Yeah.
They see a casino, right? Not a bank.
Right, exactly. But today, our mission here is to completely separate that really outdated public sentiment from the very real, very tangible, fundamental reality. Cause the financial data that's rolling in for this company in 2026, it tells a shockingly different story.
It really does.
We are no longer looking at some speculative startup here. We're looking at a rapidly maturing, highly profitable financial powerhouse. Yet, if you're listening to this and you pull up their stock chart on your phone right now, you are probably thinking we are totally crazy.
Oh, yeah, because it looks disastrous.
It looks awful. So we're going to figure out together if this current price drop is just a dangerous trap you need to avoid, or if the market has actually just handed you this completely mispriced, rare entry point for building long-term wealth.
Yeah, it's really the ultimate tension between market narrative and raw data. The narrative out there is screaming panic, but if you look at the company's ledger, it is screaming growth.
Okay, let's unpack this, because we really need to start with this massive divergence between the ugly exterior of the stock price and the incredibly powerful engine running underneath the hood.
Right.
So looking at the stock's recent performance, it is rough. We are in a deep, punishing corrective phase right now. The stock is currently down 55% from its all-time high.
Yeah, that's a huge haircut.
And it has suffered a brutal 38% year-to-date decline just in 2026 alone. So looking solely at that chart, I think anyone would assume the core business model is just falling apart.
You would think that, but the business isn't falling apart at all. In fact, if you just put your hand over that stock chart, like literally block it out and only look at their fiscal year 2025 growth metrics, you'd assume you were looking at one of the hottest, most fundamentally sound companies on the market.
Really?
Oh, yeah. Their revenue surged by 52% year over year.
Wait. 52% top-line revenue growth for a company of this size?
Yes. It is a massive top-line expansion. But, what really matters to an investor isn't just revenue, right? It's how that new revenue actually translates to profit.
Right, exactly.
And their adjusted EBITDA skyrocketed by an unbelievable 76%.
Okay, I want to pause you right there because we throw around terms like adjusted EBITDA a lot in finance. Let's make sure we are totally clear on the mechanism here.
Yeah.
Essentially, we are talking about their core operational cash flow before the accountants step in to deal with taxes and depreciation, right?
That's exactly right.
So a 76% jump in that operational cash that doesn't just happen by accident.
It absolutely doesn't. It's the direct result of something called operating leverage. So think about how a purely digital platform works, right?
Okay.
Once you cover your massive fixed costs, so that's building the core app infrastructure, paying all your software engineers, maintaining your servers once that's paid for, every new dollar of revenue that comes in doesn't actually require a lot of new spending.
So it just drops right through.
Exactly. It drops almost straight to the bottom line as pure profit. That operating leverage allowed them to expand their profit margins by a massive 8 percentage points in a single year.
Wow. 8 points.
Yeah. In the financial sector, expanding margins by 8 points while simultaneously growing your revenue by 52%. That is elite territory.
Yeah.
It proves they aren't just, buying growth with heavy marketing. They are operating a highly efficient digital machine.
So I am really trying to wrap my head around this disconnect. The business engine is running at maximum efficiency, they are generating massive cash, but the stock is cratering.
Right.
Let me throw an analogy at you. Is buying this stock right now essentially like buying a beautifully renovated house, perfect foundation, brand new roof, top-of-the-line appliances, but it just happens to be sitting in a severely depressed neighborhood?
That is, yeah.
And in this case, the bad neighborhood driving down the property value is the broader crypto market.
That is a highly accurate way to look at it, actually. The broader market algorithms and a whole lot of institutional momentum traders, they are effectively redlining the stock based on its zip code.
Wow.
They're still categorizing the company as a speculative, crypto-adjacent asset. Because the crypto market has taken a severe beating lately, the market just automatically assumes this company's going down with the ship.
They don't even look at the new roof.
Exactly. But this massive divergence is exactly why independent analysts like those over at Seeking Alpha are actually upgrading the stock to a buy right in the middle of a 38% drawdown.
They are looking at the upgraded house, not the distressed neighborhood.
Correct. They see a company that has fully transitioned into a highly profitable operation, and they recognize that the market is just completely ignoring that transformation.
Okay, let's talk about how that transformation actually happened, because you don't just grow revenue by 52% without fundamentally changing what you are selling.
No, you don't.
This wasn't just some sudden spike in people day trading stocks on their lunch break. This was a very calculated pivot, right? From being a simple, single-purpose trading app to an all-encompassing financial super app ecosystem.
Yeah, and the phrase super app is definitely an overused buzzword in tech right now.
Oh, for sure.
But we are actually watching the mechanics of it successfully play out right here. Look at the assets flowing into the platform. They're assets under custody, which is just the total dollar value of everything users hold on the platform exploited by 68% year over year.
68%.
Yeah, and that isn't just because the stock market went up. That indicates incredibly strong net new deposits. People are taking fresh money out of traditional banks and moving it onto this app.
And crucially, they aren't relying purely on unpredictable transaction fees anymore, right? Like, they have built a high-margin, recurring revenue engine.
Yes, exactly.
Their gold subscribers, which are the users paying that flat monthly fee for premium features and higher interest rates, those increased by 58%.
Right.
Because of that, the average revenue per user, which is a critical metric, grew by 16%. But here's where it gets really interesting, the retirement segment.
Oh, the retirement data is genuinely staggering.
I was floored when I saw this. Their retirement assets under custody are up an astounding 102%.
It's wild.
They also recently launched a dedicated banking product, and in under 6 months, they amassed over $1.5 billion in deposits from nearly 100,000 customers.
Yeah.
But hold on, I need to push back here for a second.
Sure.
I am having a very hard time picturing, like, a 50-year-old moving their life savings in their 401k into the exact same app that teenagers use to trade meme coins.
I get that.
Are these actual retirement rollovers or just 22-year-olds throwing $50 into a Roth IRA for the very first time?
Yeah.
How are they successfully stealing long-term retirement assets from legacy giants like Charles Schwab or Fidelity?
Well, it is a mix of both. But you are severely underestimating how much wealth older millennials and early Gen Z now possess.
Fair point.
They aren't 22 anymore. They are in their 30s and early 40s, and they are starting to consolidate their finances. What's fascinating here is the power of ecosystem lock-in through frictionless bundling.
Okay, frictionless bundling. Break that down.
So we often mistakenly call this a network effect, but a true network effect is like a telephone act. It gets more valuable when more people have one.
Right.
This is different. This is about eliminating administrative pain. Financial management is exhausting. You don't want to log into one app for your checking account, a clunky website for your IRA, another app to buy some crypto, and yet another to buy a few shares of an index fund.
No, nobody wants to do that.
Exactly. By integrating standard brokerage, crypto, retirement matching, and FDIC-insured banking into one incredibly sleek, fast interface, they completely remove that friction.
So you just consolidate your entire financial existence onto a single dashboard on your phone.
And once a user does that, the psychological and logistical switching costs of unwinding all those accounts and moving them back to a legacy bank are simply too high. You just don't do it. Furthermore, this company possesses a massive digital native cost advantage. Think about a traditional legacy bank. They are burdened by thousands of physical brick-and-mortar branches, expensive commercial real estate, massive overhead.
All those tellers.
Exactly. And decades-old legacy computer mainframes that require literal armies of IT staff just to keep running.
While this company was built entirely in the cloud from day one.
Exactly. That incredibly lean modern infrastructure allows them to offer incredibly aggressive yields, like 5% or more on uninvested cash, or massive matching percentages on IRA deposits. The legacy players simply cannot match those offers.
Why not? They have way more money.
Because if a traditional bank suddenly offered 5% on all their checking accounts, it would completely cannibalize their own existing profit margins. They are trapped by their own size. The digital platform is using its low-cost structure as a weapon to capture massive market share.
It is a brilliant mechanism. They lure you in with a high yield on your cash, and once you are used to the interface, you think, well, I might as well move my IRA over here too.
Exactly.
But let's look at how the people actually running the company view all of this. Because if the fundamentals are truly this strong, and this digital moat is this deep, despite the stock price dropping 38% this year, what are the insiders doing about it? Are they panicking?
Not in the slightest.
Yeah.
They are deploying massive amounts of capital to bet on themselves.
On March 24th and 25th of 2026, the board of directors authorized a staggering $1.5 billion share repurchase program.
Yeah.
Let's put that volume in context for the listener. This is not some token gesture designed to make the quarterly earnings report look, a little more palatable. That $1.5 billion represents nearly 10% of the company's entire market capitalization.
It's massive. That is a monumental allocation of capital. It proves definitively, beyond any marketing spin, that their balance sheet has officially transitioned from a cash-burning tech startup to a mature, highly cash-generative machine.
Right.
You simply cannot authorize a $1.5 billion stock buyback if you are struggling to keep the lights on or fund your daily operations.
Wait, let me interrupt and play devil's advocate here.
Go for it.
If management is so confident that they are dropping $1.5 billion on their own stock, why is Wall Street dumping it? What are the institutional guys seeing that management is ignoring? So what does this all mean for the listener trying to build a long-term portfolio? Because companies announce buybacks all the time just to offset the dilution from employee stock options.
Sure, they do. But if we connect this to the bigger picture, repurchasing 10% of your own company does something very mechanical and structural to the stock.
Okay.
Think of the company's total future profits as a giant pizza.
I like pizza.
Right. Management just stepped in, bought back, and permanently destroyed 10% of the slices. Now, the pizza itself didn't get any bigger, but if you were a shareholder holding the remaining slices, your slices just mathematically got significantly thicker and more valuable. By removing that much supply from the open market, it provides a tangible structural floor for the price.
So it's the management team looking at the plunging stock price, looking at their internal cash flow projections, and basically saying, well, the open market has lost its mind, so we will just buy it ourselves.
That is the ultimate signal of insider confidence. If the executive team believed that the 38% drop in the stock price was fundamentally justified by a failing business model, they would be aggressively hoarding that cash just to survive.
Because they'd be terrified.
Exactly. Instead, they're buying your own stock because they believe it is genuinely the highest return investment they can make with their capital.
Okay, so we have built a very robust bullish case here. The fundamentals are highly profitable, the super app bundling strategy is clearly stealing market share, and insiders are creating a massive structural floor with this buyback.
Yep.
But any smart wealth strategy requires us to look at the bear case with our eyes wide open. We have to ask, why is the stock down 38% this year? And the answer to that lies in the crypto shadow and global macroeconomic volatility.
Yeah, we cannot ignore the macro environment. It is the primary headwind depressing the valuation right now.
Right. Because Bitcoin recently suffered a severe 50% crash from its October 2025 all-time high of $126,000.
Brutal.
Cathie Wood was actually recently out providing some pretty stark commentary on this crypto overhang, highlighting how heavily a Bitcoin crash weighs on overall retail investor sentiment. And the fundamental reality is crypto trading still accounted for 20% of this company's 2025 revenue.
Right, it's a big chunk.
A prolonged crypto winter where nobody is trading digital assets is a very real mathematical threat to their transaction revenues. On top of that, we have broader geopolitical risks. Analysts are actively pointing out that economic fallout and rising tensions in the Middle East consistently lower overall retail broker engagement across the board.
Because historically, when the world gets scary and unpredictable, retail investors freeze. They just stop trading and move to the sidelines.
Exactly. So I have to challenge the resilience of this new super app ecosystem. If Bitcoin catches a cold, does this company's entire transaction engine still get pneumonia? Are they still just too fundamentally tethered to the volatile crypto roller coaster for a conservative, long-term investor to ever feel safe putting their money here?
This raises an important question.
Yeah.
And frankly, it is the exact question institutional investors and Wall Street algorithms are wrestling with right now.
So,
We have to acknowledge the risks completely fairly here.
okay.
A 50% drop in Bitcoin prices is absolutely going to hurt their transaction volume.
Yeah.
There's just no way around that. But we also have to look at the mechanical mitigations the company has strategically built over the last 2 years.
You mean the diversification into banking and retirement?
Yes. Let's look at how those geopolitical tensions and market fears actually play out on the platform now. Historically, during high volatility, users would withdraw their cash entirely and take it to a traditional safe haven bank.
Right. They'd pull it all out.
But remember that $1.5 billion in new banking deposits we discussed.
Yeah.
That new banking feature actually serves as an internal flight to safety product. Now, instead of withdrawing their cash from the app entirely during scary times, users simply sell their volatile equities or crypto, and they park that cash right inside the app's high-yield savings account. The money never actually leaves the ecosystem.
Oh, wow. That is a massive structural shift in the business model. They retain the user's capital, and they still monetize those deposits by earning a spread on the interest.
Furthermore, their core demographic is really unique compared to a legacy broker. They have a younger, highly mobile-first user base that actually tends to engage with the platform more frequently during periods of high market volatility.
Oh, because they want to buy the dip.
Exactly. They have been conditioned over the last 5 years to trade the dips. So while a legacy broker might see user engagement completely flatline during macro stress, this platform often sees spikes in login activity. They've essentially hedged their own volatility risk by offering both the highly speculative trading assets and the safe haven high-yield cash assets under one single roof.
That explanation makes a lot of sense. The underlying business is far more insulated from a crypto crash than it was, say, 3 or 4 years ago.
Way more.
So, having weighed the real mathematical risks of a crypto winter against the massive buyback floor and the super app growth, let's look ahead. What are the specific upcoming events in the next 3 months that could force the broader market to finally wake up and reprice this stock to its actual value?
Well, the first major hurdle is going to be Q1 2026 earnings.
Okay.
The analyst community is going to be hyper-focused on one specific metric, and that's momentum. They want to see if those new banking deposits can maintain their rapid growth trajectory past that initial $1.5 billion mark. They also want to see if the crypto trading volumes have managed to stabilize despite the severe drop in underlying Bitcoin prices.
And speaking of Bitcoin, a macro recovery in the crypto markets is obviously the second catalyst, right?
Absolutely.
Since Bitcoin is currently down about 47% from its peak, any sustained rally would act as an immediate sentiment boost for the stock. Even if crypto is only 20% of their actual revenue, the psychological tether in the minds of investors is still there.
Oh, for sure.
But the third catalyst is the true wild card, and honestly, the mechanics of it are fascinating. It's the prediction market expansion.
Yes, the push into retail event contracts.
There are widely circulating, though currently unconfirmed rumors that the company is positioning to completely dominate U.S. retail prediction markets. For anyone unfamiliar, an event contract is fundamentally different from buying a stock. What exactly are we talking about here?
So you aren't buying a piece of a company. You're essentially buying a yes or no contract based on a real-world outcome.
Like a bet.
Sort of, yeah. For example, you might buy a contract predicting whether the Federal Reserve will cut interest rates by a specific date or whether national box office sales will hit a certain monetary threshold this weekend.
Oh, interesting.
If you are right, the contract pays out. It is a highly engaging, high-margin product that perfectly fits their user base.
But the regulatory environment around these contracts has always been incredibly tricky, hasn't it?
Oh, extremely.
Yet right now, we are seeing a crucial regulatory tailwind. The U.S. federal government is actively suing states like Arizona and Illinois specifically to stop those states from regulating prediction markets at the state level.
And just to be entirely clear on the mechanics of this, without taking any political stance on the lawsuit itself, the business implications are what really matter for the stock.
Right, right.
The federal government, primarily through the Commodity Futures Trading Commission, asserts that these markets fall under federal jurisdiction. By actively pushing back against fragmented state-by-state regulation, the federal government is effectively clearing a unified national path for expansion.
It is genuinely counterintuitive to see the federal government stepping in to protect these prediction markets from state interference, but the business implication is undeniable. If this regulatory path is cleared nationally, it unlocks an entirely new, highly profitable revenue vertical for the app. It doesn't require users to understand complex corporate balance sheets. It just requires them to have an opinion on current events.
And when you synthesize all of these upcoming catalysts together, the stabilizing earnings, a potential macroeconomic crypto bounce, and the clearing of federal regulatory hurdles for highly engaging new product lines, you create a pressure cooker of undervalued fundamentals for the stock.
The fundamental value of the company is expanding rapidly while the stock price is being artificially compressed by a transient crypto narrative.
Exactly. The only real caveat here is execution.
Okay.
The CEO has laid out an incredibly ambitious product development vision. The engineering and management teams need to continue flawlessly executing on that super app integration to actually realize the value of these new revenue streams.
Which brings us to the final investment thesis, the core elevator pitch for your portfolio. After looking at today's analysis, we are looking at a final score of an 8 out of 10 bullish rating. The single most important takeaway you need to understand is that the open market is currently offering you a very rare, deeply distressed valuation on a highly profitable financial technology company that is growing its top and bottom lines at elite market-leading rates.
That's the bottom line.
And it is offering you this massive discount simply because of a temporary overhang in crypto sentiment.
It is a textbook mispricing based on outdated narratives.
Yeah.
But it is vital to clearly understand the target horizon here.
Yeah, timeline matters.
If you buy this stock, this is not a quick 3-month flip. This is a multi-year hold. It requires the emotional patience to sit through the current volatility cycle until the broader institutional market fully recognizes the successful diversification into banking and retirement products.
Right.
You're essentially buying the raw fundamentals today and waiting however long it takes for the market sentiment to catch up.
You are buying the beautifully renovated house while it is cheap and waiting for the rest of Wall Street to realize the neighborhood is changing.
Perfectly said.
But before we wrap up today, I want to leave you with one final provocative thought to ponder on your own. Something that builds on everything we've discussed today, specifically regarding that astounding 102% growth in their retirement assets.
Okay.
We know this platform's demographic is young millennials and Gen Z. We also know that over the next 10 to 15 years, the absolute largest transfer of wealth in human history is going to occur, the great baby boomer wealth transfer.
We're talking about tens of trillions of dollars passing from one generation to the next.
Trillions. So ask yourself, what happens to traditional legacy Wall Street wealth management firms when this digitally native generation suddenly inherits that massive historic wealth?
That's a great question.
Are those inherited trillions going to stay comfortably parked at the legacy brick-and-mortar banks their parents use, dealing with high management fees, paper forms, and clunky, outdated websites? Or are those assets going to seamlessly migrate directly into the sleek, frictionless super app that this younger generation already uses every single day? It is a multi-trillion-dollar question, and this company has positioned itself right at the center of the answer. Think about that.